Market cycles are essentially distinct patterns that frequently result from both the psychology of market players and the larger economic environment. Every market experiences this as a natural occurrence, and the cryptocurrency market is no different. Beginning with little to no market interest, crypto market cycles can occur. However, asset prices often increase as interest and demand increase to keep up with the escalating demand. Prices eventually peak and begin to decline as supply exceeds demand and interest rates start to fall. Each cycle has an end and a beginning. Even while it can be challenging to predict when a market cycle will begin or conclude, the majority of cryptocurrencies, apart from stable coins, go through a similar progression. You may participate in the market more intelligently if you are aware of the traits of each stage and how a typical user might approach each of these stages. A typical cryptocurrency market cycle consists of 4 distinct price trend stages that are brought on by various external variables. In this video, we will discuss how they appear and how to use them to your advantage. At Finance Doc, we will be sharing more explanation videos related to cryptocurrencies, trading, forex, and many more. If you are new to this channel, quickly hit the subscribe button and click on the bell icon to get notifications for our future videos. And if you have already subscribed to the channel, don't forget to hit the like or dislike button and share your thoughts in the comment section below. So, let's begin the video. The accumulation phase. The initial stage of every market cycle is accumulation. It begins following the conclusion of the preceding cycle, when sellers have left the market and it is thought that prices are starting to stabilize. As interest in the market remains low, the market volume is often lower than average during this phase. As a result, no distinct trend develops, and assets often trade in a narrow range. Characteristics. Market sentiment is dominated by disbelief and uncertainty. Low price volatility. Low trading volume. The downturn often ends during the accumulation period, which is also referred to as a consolidation phase. Due to the difficulty in predicting whether the asset will continue to trend lower, some market participants may still view it as a risky moment to invest. But from a different angle, long-term investors frequently view the accumulation stage as the build-up to what they believe will be the beginning of a bull market. For long-term customers who want to buy and hold, this time period is particularly appealing. However, patience is essential for short-term traders because this stage might persist for weeks, months, or even years. Positive news about the general state of the market can now draw participants' attention and possibly move the market into the next stage, the markup phase. The markup phase. The markup phase, also known as the bull market period, is when the market prices rise at an accelerating rate. New groups of market players enter the market during the markup phase, and this typically results in a noticeable increase in volume at the beginning of this phase. Market players start to feel more optimistic about the future, despite their continued caution, as businesses and the press start running good headlines. When the supply of an asset starts to exceed the demand, prices start to rise as a result. Characteristics. Market sentiment is dominated by optimism and excitement. An uptrending price chart. Increase in trading volume. Favorable economic conditions. Since the upward price trend is much easier to spot during the markup phase, it can be a favorable moment for new participants to enter the market. Additionally, many people view dips or pullbacks during the markup period as a buying opportunity rather than a warning indication. Despite the general optimism in the markup phase, assets won't always go up in value. Not all assets follow the general trend. some may still be impacted by unfavorable information that is specific to them, which could lead their price to buck the trend. If you are still watching this video, don't forget to hit the like button and share your thoughts in the comment section below. If you haven't subscribed to the channel yet, please subscribe, as that motivates us to bring more videos like this for you. The distribution phase. After a bull run, some purchasers eventually turn into sellers. The market's buyers and sellers are in equilibrium throughout this phase of distribution. On the one hand, there are market players who continue to look to buy because they believe the bull market is still going strong. Sellers on the other side are attempting to lock in their profits. As a result, there is conflict between the bulls and bears. Although there is still a lot of trade during this stage of the market, asset values often move within a specific range until one of the bulls or bears gives up. Because of the ongoing ambiguity over whether the upswing will continue or if a bear market is on the horizon, this phase may cause the overall market sentiment to change from hopeful to a separation between greed and dread. Analysts frequently employ the Fear and Greed Index to measure this shift in market mood. Characteristics. Market sentiment is simultaneously colored by overconfidence, greed, and uncertainty. Low price volatility. Elevated trading volume, but without an increase in price. The distribution phase is also the initial indication of a bear market's end. Consequently, some may draw the conclusion that a new downward trend may be on the horizon. The markdown phase. For the majority of market participants, the bear market or markdown phase is the most terrifying. It begins as soon as the supply in the distribution phase outpaces the demand, and it is a time when the market is driven by anxiety as the outlook darkens. The selling pressure increases as participants' fears about the future state of the market grow. This cascade effect has the potential to drive asset prices to heights unseen since the markup period in some circumstances. Technically speaking, a downtrending chart and a steep price fall indicate the discount phase. From the viewpoint of market sentiment, it starts when news items start to turn negative and use phrases like recession in their titles. Characteristics. Market sentiment is dominated by anxiety and panic. Downtrending price chart. Elevated trading volume. Unfavorable economic conditions. A short seller's paradise and the time when they stand to profit from the market decline is the markdown phase. Even positive news can struggle to reverse a downward trend in an asset during this time, since investors are taking precautions to limit losses in the challenging market environment. However, there is hope because such stages are transitory in nature. The new crypto market cycle often begins at the conclusion of this period. Another markup phase could be in store for us soon. Hope that this video has been able to provide you with a clear idea about the 4 phases of the crypto market cycle. Share your thoughts in the comment section below to let us know. See you in the next video. Until then, take care and stay fit in health and wealth.
Thank you for watching this video. If you like this video, don't forget to hit the like button and subscribe to the channel so that you don't miss out on our upcoming videos.